Hey guys, this is Alan Moore, certified financial planner and founder of Serenity Financial Consulting. Thanks for joining me. So a reader emailed me this week to ask, basically, should I pay down my mortgage or invest in my 401k? So this person has a few extra bucks each month and they're not sure what they should be putting their money towards. It's a great question that I get pretty often, so I wanted to go ahead and address it here. As usual, there's a lot of variables, so there's no single right answer. So here are a couple of the questions that I would ask myself if I were in your shoes and trying to decide if I should pay off my mortgage or save for the future. Number one, do I have an emergency fund? Now, it may seem unrelated, but if you don't have an emergency fund yet, just stop. I wouldn't be thinking about paying down debt. I wouldn't be thinking about saving for the future. I would be more focused on building up an emergency reserve for 3 to 6 months of living expenses. Okay, that's first. I would not skip that step. Okay, the second question is, what is my mortgage interest rate? Okay, so if you have a mortgage interest rate of, let's say, 6%, and you choose to pay it down or pay it off, you are essentially getting a 6% guaranteed rate of return. Okay, guaranteed. Now, I don't know of anywhere in the market right now where you can get 6% guaranteed. So that would probably be a pretty good deal. Now, if your interest rate's at 2.75%, maybe it gets a little muddy. But just so you know, whenever you pay down debt, it's a guaranteed rate of return. And in order to match that 6% in the market, not only do you have to get 6% in the market, you got to get more than that to compensate for the fact that there's risk in the stock market. It's not guaranteed to go up at 6%. So you're probably looking at, you need to get 8, 9, 10% of the market to make up for the fact that you're not getting a guaranteed rate of return. So it's just something to consider. The next question is, what is my tax rate? Since interest on a mortgage is tax deductible, a 6% interest is not really a 6% interest. Actually, if you're in the 35% income tax bracket, a 6% mortgage rate may actually only be costing you about 3.9%. So the calculation for this is to take your interest rate and multiply it times 1 minus your tax rate. Okay, so 6% times 1 minus 35% works out to 3.9%. So just so you know, if you are actually able to deduct your interest, that's what you're actually paying for your mortgage interest rate. Which leads into the next question is, am I even itemizing my deductions? So keep in mind that in order to deduct interest, you have to be itemizing deductions. So the first question is, are you? Because let's see, 54% of Americans paying on a mortgage are not receiving any tax benefit because they don't itemize their deductions. So take a look at last year's tax return and see, did you itemize? And if you did, how much more were your itemized deductions than your standard deduction would have been? If this is not a very large number, then the question about what's your actual tax rate may not even matter, because you are probably not getting that much of a benefit from the tax savings anyway, so your 6% mortgage may actually be 6%. The next question that I love to ask, and I want you to really consider this, ask yourself, would I borrow money to invest in the stock market? Would I take out a loan and put that money in the stock market? When I ask my clients this, I get a resounding no. Okay, so then I say, well, what if I loaned you money at 6%? Would you invest that in the stock market? Would you take out a loan at 3%? Well, essentially, if you are not paying down your mortgage and are instead investing for the future, you are borrowing money to invest in the market. It's kind of interesting, but that's the way it actually works. So if you have $100 and you choose not to pay down your mortgage that's at 6%, and instead you put it into retirement savings, you're actually borrowing money to put into the stock market, which most people wouldn't do. So it's just something to consider. If you wouldn't do this directly, if you wouldn't go down to the bank and take out a loan and invest that money in the stock market, why are you willing to do it indirectly? So it comes down to the question of which one should you be doing, and the answer is you have to find what works for you, what's most comfortable for you. The one real thing we haven't talked about is the psychological benefit of paying off a mortgage. I've never had a client come to me and say, Alan, I regret paying off my mortgage. I wish I hadn't have done that. There is a huge relief that comes for most people whenever they are debt free. So that really cannot be overstated. I think it's incredibly important. Most clients tend to kind of create a balance. So if you've got your emergency fund in place, you're fully utilizing any match on your 401k at work, it's okay to put the rest of the money towards debt payoff or split it between debt payoff and savings. Either way is fine. But again, you just have to find what's going to work best for you. So what do you think? Are you approaching this decision and trying to decide what to do? Have you paid off a mortgage and have any advice for other watchers of the video or readers of the blog? Definitely feel free to share in the comments section. Well, that's all I have for today. Thanks so much for joining me.